I'm just going to record. Awesome. So make sure I've got plenty of pens. Okay. Hello again, everyone. So awesome session for you tonight. We're looking at the cost of debt, how that incorporates tax, how we can look at gearing and leverage within a business, and also how the cost of debt, when combined with the cost of equity, is used to estimate the weighted average cost of capital. The weighted average cost of capital is used as a discount factor then to discount forecasted future cash flows to get a net present value or a net value of future cash flows, or a net present value. And that's why the weighted average cost of capital is really important to understand when you want to really deep dive into a business and understand how that discount factor has been calculated, how the business essentially ticks, how it's operated, how it's financed, how the market views your business or the business if you're going after a target, how you can look at private companies, public companies, why it's important to look at gearing and how a business is financed. And we're going to cover the second half of the weighted average cost of capital calculation this evening. So I'm Ian Smith. I won't forget my name. I am TheStrategySmith. I'm a management consultant and business coach. So I've worked in mergers and acquisitions, in strategic planning, and I've managed projects worldwide. I'm also proficient in corporate finance and things like that. So I'm able to analyse businesses from a valuation standpoint and make strategic decisions in terms of the operations that will ultimately impact growth for the business, whether it's high profits, higher sales, increased pricing, better valuation, better gearing, etc. And we'll touch on some of that this evening as well. Just to recap on the cost of equity. So in terms of the cost of equity, what we've covered is there are two methods that you can calculate the cost of equity with. One is the capital asset pricing model. That looks at the risk-free rate added to the equity beta, which measures the fluctuation of the share of the target or entity. So if, for example, the market, in terms of its market beta or the return on the market, averages at, let's say, 1, a factor of 1. An equity beta is shown relative to the fluctuation of the market. And so, therefore, if an equity beta has a value of 0.5, then it's showing a fluctuation that's below the average of the return on the market. If it has a fluctuation of 2, then it's a highly volatile average fluctuation for the beta. That increases risk, which therefore demonstrates the level of risk within the equity of the business that finances the business from its shares. So we take the equity beta and then multiply that by the equity risk premium and minus the risk-free rate. So that's the capital asset pricing model. It's good because it's simple to use. You can learn a lot about a business when you use it. And the disadvantage I mentioned was that it's a snapshot in time. The other method was the dividend valuation model. So looking at a business's dividends over the share price and adding the growth of dividends moving forward. That's good again because it's simple. You're able to forecast the growth of a business. Some of the disadvantages is that the growth factor that you calculate is based on previous performance or previous issuing of dividends, and it can be made more accurate by adding in more periods with more growth factors for the periods and making that G much more accurate. and therefore the dividend valuation model demonstrates the cost of equity based on the dividends and the value of those being issued to shareholders. And therefore, the next part is looking at how the business is financed in terms of equity, in this case, equity over debt plus equity. And then the equity half of the weighted average cost of capital calculation takes into account the cost of equity multiplied by the cost of equity multiplied by the cost of equity multiplied by the way that the business is geared, equity over debt plus equity. Okay, so what we're going to do is I'm just going to clear this board, and then we're going to cover the cost of debt. The cost of debt will be on this half of the board, and when I draw it, I'm going to draw some more tables and things on this half, and then I'm going to draw the whole thing all together so you can see how the weighted average cost of capital calculation is built. Okay, let's get a clean board. And I'll just talk to you whilst I do this, is that I'm going live tonight on 5 platforms. And I always respond to all of the comments, but I might just not see them live because I'm going live across 5 platforms. So please like, subscribe, and comment depending on the platform that you're watching from. I'm going live on LinkedIn, X, Facebook, on LinkedIn, Facebook, YouTube, X, and the other one. And then with the live platforms, we're able to look at the different elements of integration within the platforms. So if I just talk to you a little bit about the cost of debt. What's important when looking at the cost of debt is that investors want a return on their investment. Lenders want to take into account the element of risk for a business. And so we must take into account the cost of debt for the weighted average cost of capital calculation, because we're able to understand how the business is financed and the cost of financing it, and also the level of risk within the business as well. So where we start from to get the cost of debt is there's 2 calculations again. There is the risk-free rate. Okay. Talked a little bit about the risk-free rate before, but the nearest thing to a risk-free rate is a short-term treasury bill or a long-term bond. So it essentially is what the banks are able to lend without there being any risk to the return of that. But even if an investment is risk-free, investors still require some form of a reward. And so what's taken into account for this risk-free rate is an element of inflation as well. Now, to compensate for time preference and to include an element of inflation, that will give the real rate of return. If a debt is risk-free, then an investor should get, or a lender should get, a risk-free rate of return. However, corporate debt, so debt of a business, is not risk-free. And so we need to factor in a credit risk premium for the cost of debt. So lenders and banks require more of a return than the risk-free rate and for this credit risk. So it's known as the credit risk premium. And that's added to the risk-free rate. So the credit risk premium, that's taken from or can be taken from the credit rating of a business, and it's looked at the debt premium for the business, and it can be compared with, for example, if a business has a credit rating of AA plus, okay, then a CFO would look at, for example, the yield required for bonds rated AA plus in general, and then compare that with the bonds of the same maturity. With the yield required of the bonds of the same maturity. And so what you're able to do is calculate from a government bond rated AA plus, how does that factor in terms of its yield in general, and compare the yield required for bonds rated AA plus in general with the yield required for government bonds with the same maturity. That will give you a factor. So you might have a AA plus, that might give you a factor of 0.63, for example. If you've got a credit rating of A minus, for example, it might give you a required yield of 0.99, and these are basis points. So a basis point is 1/100th of a percentage point. So 0.99 rounds up to 1%. So if for example, you had a credit rating of A minus and the yield for a government bond with the same maturity, and then you can factor this in for different businesses to do comparisons and things like that as to what the credit risk premium would be. And the risk-free rate could be, example, 3% yield required for a long-term government bond, 1% inflation. So you would have 4% in total, plus 1% for the credit risk premium. So the cost of debt in this case, for this scenario, would be, example, 5%. And that's how it's calculated, because a lender looking at the cost of debt for this business would say, well, in terms of a risk-free rate, I want that as a minimum. But because this business has a good credit rating of A minus, would have a better rating if it was AA plus or AAA, then we add 1% for a credit risk premium, because I want a reward for that credit risk, because corporate debt is not risk-free. And this is where credit rating is factored in. And you're able to understand the yield for the credit rating required to ensure that the lender is getting sufficient risk for the risk premium in terms of the risk of the credit rating into the business. That will give you a percentage, and again, the higher that percentage, the larger the discount rate will, the discount factor will be, because you're taking into account the cost of debt and multiplying that eventually, when we get down here, to corporate tax rate, 1 minus the corporate tax rate. And I'm going to explain why tax is important in this calculation as well. So that's one calculation for the cost of debt, taking into account the risk-free rate and the credit risk premium, which compares the yield required for bonds rated A minus or AA plus in general, with the yield required for government bonds with the same maturity. And that's what this gives here. And then you can add those two together, which will give you the cost of debt in this case. There's another calculation to calculate the cost of debt, and it's called the cost of borrowing. What about a pen? Okay. Cost of borrowing, you're able to get that from consolidated balance sheets if you're looking at an entire group. If you want to do some form of carve-out, or you want to look at a specific entity, it should have its own balance sheet, or you're able to create it as part of the business plan. So if you're building a pro forma, I build pro formas where I get all of the information that I need into different templates and model it, so I understand. And long story short, it gives me P&L, balance sheet, cash flow. But then I also look at other things like depreciation and all that kind of stuff. But if you're looking at an annual report for a business, if you wanted to do this for a public company, they will have consolidated balance sheets, which takes into account all of their subsidiaries usually within a country. You'll have group reports if you're a global business, which also factor in different subsidiaries. And essentially, this information is as good. These calculations is as good as the information that's put into it. So if you want to get a really accurate cost of borrowing for an entity within a business, then it needs to have its own balance sheet for you to understand annual interest divided by the average annual debt. Got that to right. Annual debt. Okay. So in terms of annual interest, it's from the current year. And you'll be able to find interest expense for 2023 or 2024, or whichever year you're calculating it from. Sometimes it's allocated in notes in terms of annual interest that you're paying on debt. And the annual average debt is taken over the period of time that you're measuring the debt that's being taken on by the business. So, for example, if you want to look over previous 5 years, you'd look from today to 5 years prior, average the short and long-term debt from the business. So you would look at short and long-term liabilities from balance sheet minus 5 years ago, minus 4 years ago, minus 3, minus 2, minus 1, etc. And then you would add those together, but then average them and divide that by the annual interest. That will also give you a percentage in terms of the cost of borrowing. So that will allow you to understand the level of interest the business is paying compared to how much debt is within the company. That's very important to understand because, again, if a business is being valued and the cash flows are being discounted, you need to factor in that risk of interest that will be paid and also debt based on previous debt requirements. What that looks like in terms of a percentage. So the percentage, if it's higher, again, then it's the business has taken out more debt and there's therefore more risk in the business. And what this then factors into is, so we've got cost of borrowing, and we've got the risk-free rate added to the credit risk premium. Now you can use, there we go. You can use risk-free rate plus the credit risk premium or the cost of borrowing in this case. All right, now we're going to talk a little bit about tax and why tax is important. Now, tax is important because when you look at gearing and how the business is financed, whether it's debt or equity, we need to look at it in terms of profit and loss, in terms of the statement, and how much debt and interest the business is leveraging. And I'll draw that for you. I'll draw that for you so that you know how this works in terms of profit and loss and balance sheets as well. So we'll draw cost of debt. And then we need to multiply cost of debt by 1 minus the tax rate. Then we multiply this by the gearing. So I'm going to draw for you why it's important that we incorporate tax with gearing, because gearing alone will tell you how the business is financed, but without taking into account tax, there's no difference to the value of the business, and there's no difference if we eliminate tax. There's a fundamental issue with regards to the cost of debt in the business. So if I draw this in terms of profit and loss, we'll complete this part of the equation, because that bit, this half, then gets added to cost of equity and equity over debt plus equity that I drew at the first part of the video. So this is the cost of debt half of the weighted average cost of capital. Now, we're going to talk a little bit now about gearing and why it's important to factor in tax. Okay, so what I will do very quickly is, if I shorten this equation, draw this a little bit better. Cost of debt multiplied by 1 minus the tax, multiplied by debt over debt plus equity. Okay, credit risk premium, cost of borrowing equals interest, annual interest, over annual average. I might be borrowing, right. We've got a bit more space there now. Okay, so on this side of the board, I'm just going to draw for you a quick scenario of company A and company B. Both identical, both achieving the same amount of EBIT, but one has zero debt, is 100% financed by equity, and another is 50% financed by debt and equity. So we've got, on this part of the board, we'll have, in terms of P&L, we'll start at EBIT. Now, what happens in a profit and loss statement is you've got sales, you have cost of sales, and then you've got gross profit. Then you've got expenses that come off the gross profit. Then you've got EBITDA, and then you've got depreciation. Then you have earnings before interest and tax. Now, earnings before interest and then tax. So the bank gets paid before the tax man in terms of profit and loss. So if a business has debt, then it's paying interest on that debt. If a business is 100% financed by equity, it's not paying interest, which means taxman gets more money if you've got no interest to pay, and I'll show you why. So after EBIT, we have an interest expense in brackets. Then we have profit before tax. Then the taxman gets theirs. Okay, and so you can see that if both companies are identical, so we'll say company A, company B, we've got, once they've paid tax, we've got profit after tax, but also the interest on debt to interest to the debt holders that's going to be paid. So we'll put interest to debt, interest to lenders. Okay, and then once this has come through in terms of profit after tax, and the profit after tax is the cash that you're able to keep as shareholders, then we can look at dividends available, and then we can look at total for investors. So the net dividend for shareholders, and then the total for investors. Okay, so we'll just make this nice and neat. Sure, my pens aren't all running out. Okay, so company A, company B, both the same. Company A, let's say 10 million in EBIT. Now, company A is 100% equity. Company B, 50% equity, which means they're 50% debt. So what happens with debt is we pay interest on debt. So company A has 0 interest to pay. Company B, interest, might have, let's say, 2.5 interest to pay on their debt. So the profit before tax is 10. Now you might think company A, cool, they're in the money. But